A wild swing in the stock market over the past week turned south by a disappointing inflation report. We take a look at the numbers in this week's Fastest 4 Minutes in Finance. Hello, and thank you for checking out the Fastest 4, whether you get it on radio, podcast, or email delivery. I'm Scott Inman. Well, it's early fall here in Arkansas. I've lived here for most of my life, and when September gets here, it never seems to fail. We get a little taste of cooler air and get tempted into thinking fall has arrived, only to be smacked in the face with a sudden return of 90-degree heat for a short time. That's a little like what has happened with inflation. After the July inflation data was released last month, there was building optimism that this period of red-hot price increases had reached its peak and was beginning to cool. Well, much like the dog days of summer, August data came in hotter than the market wanted. August CPI rose 8.3% year over year. It was 8.5% in July. Now, excluding food and gas, core CPI was up 6.3%, and that was actually higher than July. Gas prices, airfares, and used vehicle prices were all down, but food prices soared 11.4%, the largest year-over-year increase since 1979, and rents are up 6.7%, the fastest rate since the early 80s. The numbers sent the stock market into a tailspin. Major indices were off 4 to 5%. It was clearly seen by investors as a sign that inflation is still running too hot, which likely means the Federal Reserve will continue raising interest rates, which the market has already signaled it's uneasy about. We continue to be caught in this economic conundrum of trying to control price increases, but not to the point of sending us into a prolonged recession. That's the Fed's target of the quote-unquote soft landing, and the market clearly believes the jury is still out on that. And it likely is. Our friends at LPL Research write that the latest inflation report is sending mixed messages. Headline inflation is slowly easing, but rising food and shelter costs are putting pressure on consumers. Though, as we have always reminded you here, it's never as good or as bad as it may seem. LPL Research reminds us that the Fed's preferred measure of inflation is called PCE. That stands for Personal Consumption Expenditure. Housing costs have a lesser impact on that gauge, and that data will not come out until September 30th. If it continues to trend lower as it has, the Fed may not increase rates at a faster clip. The consensus right now is that they will raise them by 75 basis points later this month. Import prices and producer prices are falling. That's a good sign for the inflation outlook moving forward. But as always, you should control what you can control. With rates rising, it's probably not a great time to take on new debt. You should work hard to eliminate the debt you have. That will increase the margin between your income and expenses, which will in turn help you pay more for goods and services in a high inflationary environment. And stick to your plan. Don't let short-term market volatility wreck your long-term goals. Thanks for listening.